Hey, Andy here. Take two. Let's try this again. This is my second go around of recording this video for how much of your Social Security benefits may be taxable. First time I didn't realize till after the fact had absolutely horrendous video resolution quality. So this one should be better. It was on 360 before. Now it's on 720 or I think 720. So hopefully good enough to read. And I zoomed in the screens a little more. So anyway, today's video is the topic of, at the federal level, how much of your Social Security benefits, if any, might be taxable. This is not about state income tax. For what it's worth, roughly 40 states, I think 38 technically, do not tax Social Security benefits at all from a state income tax perspective. The other 10 or 12 that do might. They have their own different formulas to determine how much is potentially taxable, but that's a whole separate ball of wax. Today's video is just about the federal tax treatment of Social Security benefits. So let's start with, I'll pull up a screen share here. I have some juicy spreadsheet that'll make this all hopefully come to life. It starts with understanding what's called provisional or combined income. The two terms mean the same thing. They're used interchangeably depending what source you're looking at. But basically, provisional, it's called combined income in this table, but provisional or combined income is a measure of income used only in determining how much of your Social Security is potentially federally taxable. Specifically, the definition of provisional or combined income is equal to, or the amount of that income is equal to 1/2 of your gross Social Security benefits. So gross benefits, not benefits net of Medicare premium deductions or federal tax withholdings. It's your gross amount of annual Social Security benefits. So half of that, plus any tax exempt interest you may have on your return, which is most commonly going to be if you own municipal bonds in a regular brokerage account. The interest from those bonds is not federally taxable, but that interest is included in this definition of provisional or combined income. So again, half of gross Social Security benefits plus tax-free interest plus all your other taxable income. So dividends, interest, taxable IRA distributions, Roth conversions, pensions, annuities, capital gains from selling things, rental income if you have rentals, anything that's included in your gross income on your tax return is what's captured in this bucket. So again, just to recap, provisional or combined income, half of your Social Security, tax exempt interest, plus all other forms of taxable income. So now that you have your provisional or combined income figured out, you need to know what your tax filing status is. If you're married filing jointly, you have one set of brackets, provisional income or combined income brackets, that will dictate how much of your Social Security is taxed. If you're any of these other filing statuses, single, head of household, qualifying widow or widower, or married filing separately, subject to a little caveat here, you have a separate set of combined income thresholds. So the way this works, if you are single, for example, and your combined income is below $25,000, none of your Social Security will be included as taxable on your tax return. If your combined income is between $25,000 and $34,000, then up to 50% of your Social Security benefits will be included as taxable income. Now, notice it's up to. It's not that automatically all of your social, you go from 0 to 50% of your Social Security benefits are included in taxation. It's up to. There's a scaling sort of formula I'll show you a quick snapshot of later. So anywhere from 0 to 50% of your benefits may be included in your taxable income if your combined income or provisional income is between 25 and 34. And then if you're, again, single or these other filing statuses and your combined or provisional income is above $34,000, up to 85% of your Social Security benefits may be taxable. Again, it's up to, it's not automatically 85%, it's up to. And if you're married filing joint, you simply have slightly higher provisional or combined income thresholds, but otherwise the process is the same. Quick fun fact, these combined income thresholds have not changed since they were put into place. First in 1984, I believe it was. Social Security did not used to be federally taxable. Starting in 84, up to 50% of it became taxable. And then I think it was 1993, they added the up to 85% may be taxable. And these dollar amount of thresholds are the same they were decades ago when they were first put into place. So while they haven't decreased over the years, at least not in nominal levels, I mean, functionally, they are stealthy tax increases because as inflation happens, as people's Social Security grows throughout the years because of inflation, as other sources of income may grow, more and more people now are getting at least some of their Social Security pulled into taxation because, again, these combined income levels have not been indexed for inflation in decades, since they've been put in place. All right, so that's the background of combined or provisional income and what the thresholds are for how much of your Social Security may potentially be taxable. As far as how much is actually taxable, don't get too hung up on this. If you're interested in the gory details, you can go to the instructions to the Form 1040, and you can find in there's a page-long table. I think it's a couple dozen different rows of that formula that does this calculation for you. So you plug in all these numbers, and it'll tell you how much, in dollar amounts, how much of your Social Security is actually to be included as taxable on your Form 1040 tax return. But in a nutshell, it's a hairy, complicated formula because it's 3 different formulas you have to do, and then you take the lesser of the results of each of those 3. That's the dollar amount of Social Security that's ultimately taxable. So long story short, I manually just grind out these calculations here in a spreadsheet. Here's the 3 different tests, for example, and then you can see the resulting dollar amounts for married, filing, joint, and single. This much is taxable if you're married. This much is taxable under test 2. This much is taxable under test 3. Again, the formula says simply take the lesser of the 3. So in this particular example, this would be the number of taxable Social Security. Don't worry about that. Practically speaking, you probably do your taxes through tax return software, or you have someone who does them for you. He or she uses tax return software. Software does all this for you, clean and simple and easy. If you do actually do your returns by hand, pencil and paper, and you get Social Security, you will have to manually chug through that page-long formula or worksheet, I should say, to figure out how much of your Social Security is taxable. But I don't advise anyone do tax return on paper at this point. Cleaner, easier, safer, just do it electronically, file electronically, in which case this formula is all done for you. But if you're interested in the gory details, I mean, here it is. You can also just search, or like I said, go to the instructions to the Form 1040. You'll find that big table in the back that has this detailed formula that does this for you. This is just me summarizing in plain English, or at least plain English that I understand, what these initials are. Anyway, so this is a calculation happening, behind the scenes. Then what I do here is I built this little mock 1040 that I can plug and play. What tax year, what filing status, is anyone 65 or older, because that impacts the amount of standard deduction. So let's clear this out and start, and I'll show you how this works. There's a lot going on, but all you need to really pay attention to is this row here, and then the few rows below it. So for example, this person's single. Let's assume they're 65 or older. That's what this 1 denotes. And let's assume they have $30,000 of gross Social Security benefits, and that's it. There's no other income. Their provisional income now is $15,000. Why is that? Well, remember, the provisional, aka combined income formula, is add up half of your Social Security, plus any tax-free interest, plus all your other sources of gross income. In this case, the person's only income is $30,000 of Social Security. So take half of that. That's provisional income, $15,000. And because that's below the $24,000 threshold where Social Security taxation may kick in, 0% of this person's Social Security is taxable. So therefore, if you look at this mock 1040, $30,000 of gross Social Security benefits, 0 of taxable Social Security benefits. So this person has 0 tax obligation for the year. What if this person now takes a $10,000 IRA distribution? So they still have the $30,000 gross Social Security benefits. Now add to it $10,000 of social IRA distribution. Provisional income is $25,000. Why is that? Again, start with half of Social Security, so there's $15,000. Add to it other income, which is $10,000, and there's no tax-free interest in this example. So provisional income is $25,000, which is $1,000 over the. Is it right? Yep. No, I'm sorry. It's right at the $25,000 first threshold. So it's right at the first threshold. None or 0% of this person's Social Security is taxable. So if you look on their tax return now, their total gross income is $10,000 IRA, 0 Social Security is included. So $10,000 total adjusted gross income. What if the IRA distribution is $20,000 instead of 10? So provisional income $35,000. Again, half of Social Security, $15,000, plus the $20,000 IRA distribution is $35,000 of provisional income. Running that through the formula, 17.8% of this person's Social Security is included as taxable income. So 17.8% to 30 grand is $5,350. So now on their tax return, their gross income is going to be the $20,000 IRA distribution plus the $5,350 of taxable Social Security, such that their adjusted gross income is $25,350. And if you're interested, subtract out the person's standard deduction, which for 2022, a single person over 65, standard deduction is going to be $14,700. Taxable income is $10,650, on which total tax will be a little over $1,070. And now let's look at what if it's $30,000 IRA distribution. So just snapshot this quick. 17.8% of Social Security is taxable with a 20 grand IRA distribution. With a $30,000 IRA distribution, boom, 46.2% of this person's Social Security is now sucked into being taxed. So out of the 30 grand of gross Social Security, 46.2% or $13,850 of it is included in gross income. Add that to their 30 grand of IRA distribution, their gross income now is $43,850 minus standard deduction, and taxable income is $29,150, and total tax for the year is going to be almost $3,300. And let's just keep going. You'll see what happens. $40,000 IRA distribution. Now 74.5% of their Social Security is pulled into being taxed. So add that, which is $22,350. Add that to the 40 grand IRA distribution. Blah blah blah. Same song and dance here. So for those of you that saw my tax torpedo video I did a few days ago, otherwise known as tax trap, this is the concept I discuss. If you're in this sort of phase-in range where your Social Security isn't already having 85% of it pulled into being taxed, every additional dollar of other income you have pulls in, incrementally more and more of your Social Security into being taxed. So look, when we were at a $30,000 IRA distribution, only, let's round up, we'll call it $14,000 of the Social Security was taxable. With a $40,000 IRA distribution, now $22,000 of the Social Security is taxable. That's a pretty big difference, right? So it goes from, what was it again? $14,000, I'm rounding, to $22,000. That's $8,000 difference. So this is a torpedo concept. Your IRA distribution went up by 10 grand. So you would think, okay, my gross income is only going higher by 10 grand. No. That extra $10,000 of IRA distribution means your gross income goes up by $18,000. I'm rounding again. Went up by 10 from the additional IRA distribution, plus 8,000 more of your Social Security is now pulled into taxation because of that IRA distribution. That's the tax torpedo or tax trap. Here you see it in sort of spreadsheet tax return form. So that's it. That's all I wanted to show you. If you were married, the math is a little different because, like I showed on these combined income tables, married filing joint folks have slightly higher combined income, provisional income thresholds. So all else equal, less of their Social Security may be subject to tax than if you were single. So you can see here, for example, 30,000 combined Social Security benefits for a married couple, 40,000 combined IRA distribution for a married couple. Only 51.2% of their combined Social Security will be pulled into taxation. Whereas if this was single, and you had the same 30,000 gross Social Security, 40,000 IRA distribution, now it's 74.5% of the single person's Social Security is pulled into taxation. So that's that. Hope you found this helpful. Hopefully the resolution of these images in the spreadsheet was clear enough for you to follow along. If not, I did try to verbalize all this stuff, so at least that was hopefully clear for those of you who are able to hear the audio. All right, hopefully you enjoyed that. I'll take the screen share off now. That's all I had. If you have any questions, feel free to plop them into the notes to this video. And that's it. Thanks for watching. Take care.